IRA and 401k. And we have Terry Gardner and Aaliyah Ott with Investors in Action showing up in just 1 minute. Well, I always knew this would happen. So, moving forward, a little disclaimer here. AccuPlan, we're a third-party administrator and custodian. We're not financial advisors. So before entering into any type of transaction, please consult with your financial advisors and attorneys and things like that. So once I get my PowerPoint going, since it wanted to go slow, I'll introduce myself a little bit. I'm Brian Davis. I'm with AccuPlan. I'm the President of Business Development. I've been with AccuPlan for the last 2 years and been in the self-directed IRA space for the last just about 5 years now. I've opened up about 1,000 IRAs. Prior to this, I did life and health insurance for a year or two. And again, apologize. Oh, here we go. All right. Sorry about the delay there. Prior to that, I was with in the mortgage business from 2002 through 2007, mostly here in San Diego, where I reside, and dealing with new construction and subprime loans. And in 2007, that kind of went away from me real quick. And luckily, in 2009, I discovered the self-directed IRA field and have been really excited about it. And before that, I went to college at UC Santa Barbara up the coast. And I've been in real estate pretty much my whole life. If you think about it, my parents are rice farmers up in Northern California in the Sacramento Valley. So that's a little bit of my background. AccuPlan, like I said, we are a 401 self-directed IRA and 401k administrator. And we are third-party administrators and a custodian of IRAs. We don't tell you what to invest in. We show you how you can invest in some alternative investments. For those of you that might be new to the idea of a self-directed IRA, you're not alone. In 1974, the ERISA Act was passed by Congress, which kind of opened up the doors for IRA. What it said is you had to have a custodian to direct your IRA investments. Well, the custodians that we generally know are the banks, investment banks, brokerage houses, and insurance companies. They have products such as stocks, bonds, mutual funds, and annuities, publicly traded assets. So they don't really want to get into the messiness that might be involved in the paperwork of having a hard asset like real estate or notes or non-publicly traded companies. So under the ERISA guidelines, almost all types of investments are allowed. You just have to have a custodian that allows you to do that, and that's what we do. I need to update this slide, but at the end of 2010, there was just under $5 trillion in IRAs and another about, $11 trillion in retirement funds via 401k plans and 403b plans and other pension plans. About 98% of that is in with those traditional brokerage houses investing in the stock market, stocks, bonds, mutual funds. 2% in IRAs. Now that number, from what I've been hearing, is climbing closer to about 4%. People are discovering that they're not limited to the stock market. They can invest in real estate or a private fund. And a lot of that was with the help of Mitt Romney, of all people, who, when he was running for president a couple years ago, when his financials came out, it came to light that he had a self-directed IRA worth somewhere in the area of $100 million. Now, I don't see those all too often, but as one of my associates says, I want to learn how to Romnify my IRA, and maybe we can show you some steps on doing that today. What we mostly see at AccuPlan are these 4 asset classes: real estate, notes, which we're going to talk about those today, investing in private companies, and precious metals. The IRS has never put out a list of acceptable investments, and this is a list of a million things you can invest in. So here's some examples here: LLCs, raw land, lease options, water rights. The list goes on and on and on. But as I said, they never put out a list of what's acceptable, just what isn't acceptable. And there's really only 2 things that the IRS listed that your IRA can't invest in, and that is life insurance contracts and what they deem as a collectible. And here's a list here on this slide of different types of collectibles: work of art, rug collections, stamps or coins, and alcoholic beverages, anything illegal, and there's even some exceptions on the coin. You'll also hear that S-corps aren't allowed, and that is an S-corp rule. S-corps only allow individuals to be members. They don't allow IRAs. Now, you can still do transactions with S-corps, but your IRA cannot become a member. The big thing to look upon when investing with your IRA is to make sure your IRA doesn't get involved in what's called a prohibited transaction. So besides those two investments, life insurance, collectibles, and S-corps, you want to make sure your IRA doesn't get involved in a prohibited transaction. So what is a prohibited transaction? And this is, you can look this up in Internal Revenue Code 4975. What it says is when your IRA gets involved with a disqualified person, that transaction is said to be prohibited, and there's consequences to doing so. So who's a disqualified person? You're a disqualified person from yourself. The essence of the rule is there's no self-dealing. So besides yourself that you can't deal with your spouse and family members in lineal ascension and descension. And by that I mean your parents, your grandparents, your kids, their spouses, grandkids. Side to side is okay, but generally that straight line up and down is what you want to look at. And there's some more to it here about corporations and which one of those people owns or has managing authority over. And if anybody has more questions on this, please feel free to contact me and we can go into further look at it. The consequences for getting involved in one of these transactions is dire. The IRS can go back and look at your IRA transactions for as far back as you have your IRA. And whenever they see, if they were to find a prohibited transaction through an audit, they would go back in January 1st of that year. They could disqualify your IRA, which would cause a huge tax burden to you if you were in a pre-tax IRA. And there could be some penalties for back taxes and those types of things. So you really want to make sure you don't get involved with any disqualified person. So we'll play a little game here. I'm sure everybody remembers this game show from NBC a few years back, Deal or No Deal. Well, we'll play that with this prohibited transaction rule. So could your IRA lend you $10,000? Deal or no deal? The answer to that is no deal. That's self-dealing. You can't lend yourself money out of your IRA. 401ks, that's a different thing, and I'll cover that in a second. Now, your brother, could your IRA lend your brother $10,000? That one is deal. He doesn't fall in that lineal ascension and descension. He's on the side. I don't make these rules. I just try to help interpret them for you. Here's a tricky one. What about your stepson? Can your IRA lend your stepson $10,000? That one is deal. If it was your son, it would be a no-go. But since it's the non-blood related there, the IRS is saying that one's okay. Again, it gets tricky. Here's another one. Your daughter-in-law, $10,000. Deal or no deal? That one's no deal. Your children and their spouses. So it can get a little tricky, and that's what we're here for. And if we don't know the answers, we can direct you to a Learn the Tax Law to look, and you can consult your other financial professional. The next part about the self-directed IRA is, well, how do I get money in one? Self-directed is really just a marketing term. It means that we allow all allowable investments into an IRA. So just like any other brokerage house or insurance company, we have traditional IRAs, Roth IRAs, SEP IRAs, and even the solo 401k. So moving the funds over is just like moving it from any IRA company to another. So if you have an IRA with a brokerage house, we can do what's called a trustee-to-trustee transfer. We'll transfer your assets from them over to us to allow you to invest in all things allowable like real estate and notes, which I'm excited to have Alita and Terry talk about more here in a minute. The other option is this, well, what if I have an old 401k type plan or profit sharing plan? Can I move that over? Yeah, you can do what's called a direct rollover. You're going to direct your administrator to move the funds directly over to the IRA you create with us. You don't want to have it go to you first as a distribution and then to the IRA, because then there's a small penalty. that rarely comes into play. Generally, they know we're going to do a direct rollover, and they move it to the IRA. A frequently asked question I get here, what about my current company's retirement account? Can I move those funds over to an IRA? The answer to that is maybe. Some plans allow for what's called an in-service rollover, which means while you're still in the plan, that some of those plan assets can be rolled over into an IRA. Now, there are so many different types of qualified retirement plans that it really varies on what type of plan you have and whether that plan has it as allowable to do that in-service rollover. So you need to ask your plan administrator or HR person about that. The third and final way to put money into an IRA is making an annual contribution. And I have 2013 limits up here still because you still have until April 15th to make a contribution to an IRA. And even with the SEP IRA, it could possibly be until October 15th. So most people fall into the category of having a traditional or Roth IRA. And you can contribute $5,500 a year to one of those plans. If you're over the age of 50, there's a catch-up provision that allows you to throw in an extra $1,000. The next plan I want to talk to you about is a SEP plan. A SEP plan works very similarly to a traditional IRA in the fact that the funds that you put in are pre-tax, meaning it's a tax write-off, this contribution. For the self-employed individual, they can contribute up to 25% of their adjusted gross income with a cap at $51,000. In 2014, that limit's going up to $52,000. Simple plans are similar to 401k plans, where small businesses can have these plans and the employee can contribute into the plan and the employer can match a little bit, but they're much smaller contribution figures than a 401k. And the 401k that we have, that we provide, is what's called a solo 401k or an individual K. And this is a plan for a self-employed individual with no employees. Doesn't matter if they're just a sole proprietor or whether they've incorporated or they're LLC. This allows that individual to make contributions as both employee and employer to the plan. In 2013, the limit was $51,000. If they're over 50, it was $56,500, and that number is going up $1,000 in 2014 as well. And I'll touch on that a little bit more. One point I want to talk about with the IRA is what some of you have probably heard about is the checkbook control with your IRA. And there's two prevailing options we're seeing out there. And a lot of people say, well, Brian, you just told us it's a prohibited transaction to have control of your IRA. There was a case in the 1990s called the Swanson case. This guy Swanson had an international business company that his retirement account funded that he was the manager of. The IRS tried to argue and say this is a prohibited transaction. They ultimately lost the case. And so the checkbook IRA was born, which allows an IRA to own an entity in which the manager of that entity is the IRA owner, as long as they don't make a profit and it's set up that way from the beginning. Most of the time you'll see this done as an LLC. An LLC is when it's a single member entity, is what's called a pass-through entity. And since the passing through to the owner of it is the IRA, there is no taxes and no tax needs to be filed for that IRA. However, there is a state requirement for LLC. And if you're in the state of California like I am, that's $800 a year just to have an LLC, and something else called a gross receipts tax. That gross receipts tax is based off of all the income that's come in. It's not your net receipts, it's your gross receipts. So that could add a few extra $1,000s to a state tax if you do an LLC, which is why in California this business trust is a really good idea. The business trust has the tax filing requirements just like a partnership or LLC, so it's a pass-through entity as well federally. But because it's a trust, it doesn't have to pay the franchise tax or fee. And if you want some more information on the business trust, check out retirementcheckbook.com. Back to the solo 401k. Like I said, this plan is for that self-employed individual with no W-2 employees. You can have 1099 employees. But with the plan, you are the plan administrator. which means you're going to do all the administrating of the plan. You are the trustee of the plan, meaning you have signature authority of the plan, and you're also the plan participant as the employee. So you have a lot of hats here. And this allows you to have checkbook control of your IRA by just buying this plan and having a bank account with the bank of your choice and having no annual fees to it. So you can invest directly into your investment from your 401k plan. Some people will still create a LLC or a trust before they do their investments, but that's something you might want to talk to your CPA about. Most of my clients are just investing directly from the plan. So you create a corporation, or even don't, but you can roll over any pre-tax retirement dollars into the 401k and then start making those contributions and then direct your investment. Some benefits to that is, since it's a 401k plan and you're a plan participant, you can loan yourself money to the plan, up to $50,000 or 50% of the plan assets, whichever is lower. There's also a Roth provision of the solo 401k where your employee deferrals can be after tax, and those funds grow tax-free. And if anybody has questions on traditional versus Roth IRAs, pre-tax versus post-tax, I didn't really cover that here, but please feel free to contact me. Most people fall in line with the IRA process. They open up an account online with us. Then we work on funding the account via those three methods we talked about: transfer, rollover, or contribution, and then you direct us to make the investment. So like I said, IRAs can invest in just about anything, and that's what I have here. Let's see where my screen went here. There we go. Let me move this over to Terry and Aaliyah. You guys there?
We're here.
Yeah,
All
we're
right.
here.
Sorry for the technical difficulties at the beginning there. It always seems to happen when you least expect it. But if anybody has any questions, please feel free to contact me, 619-892-2438. Put your questions in here. We'll try to get to them at the end. We have a lot of content from Terry and Aaliyah, though. So thanks, Terry and Aaliyah, and take it away.
Thanks, Brian.
Thanks, Brian. And we really appreciate being here. We are excited to talk about something that we think is a great investment strategy for using IRA funds. In fact, we frequently use our own IRA funds for doing what we're planning on talking about here today. So I'm going to dive right in. We've got a lot of information to share with you, so we're going to go through this pretty quickly. But you're always welcome to contact us, and we'll share our contact information with you at the end. And you're welcome to get a hold of us if you have any questions or details that we didn't cover here. My name is Terry Garner, and Aaliyah Ott is also with me, and we'll be kind of going back and forth as we go through these slides. We are part of a larger team called Inspired Capital Partners, and we're a group with over 140 years combined experience in a number of different venues for real estate and other ways, buying, private lending, and note buying. So what we will cover today, we're going to talk specifically about two strategies, and the first is lending to local rehabbers as well as buying non-performing notes. And both of these are what we call the paper side of the business. And so we're going to talk about why we love being the bank and why we like the paper side versus actually owning the property. We're going to talk about how we manage risk. We're going to talk about some creative workout strategies, and then also where we are investing and why we're doing that. So let me turn it over to Aaliyah to kick us off.
Great, thanks, Terry. So we're talking a little bit about property versus paper, and when you're talking about property versus paper, there's the whole concept of being a landlord versus being the note holder. So a couple things kind of to compare and contrast is a landlord receives their rental income, and this is after the bank receives the money, the property manager, the tax man, and insurance. All of those entities really come first when it comes to doling out the money that comes from a rental property. As a note holder, you're typically paid first, so you get paid a steady amount plus late fees if there are any. as a landlord, you're responsible for tenants, toilets, and other headaches that come along with owning the property. And there's benefits to that too, but you're responsible for so much more. As the note holder, the owner is responsible for maintaining their home or their property. So really, we're just holding the note, and the landlord or the owner has to be responsible for those items, whether it's rehabs or tenants. The landlord is at risk of losing their home if they can't pay versus the note holder, which is really in the power position where you're able to foreclose and take the asset back. So huge advantage of that. As a landlord, you're responsible for any damages that occur to your property as well as liabilities. And as a note holder, you're insured as the lost payee. So if there's any problem, you're paid out first typically. The landlord is the last person to get paid at resale, so when they go to sell that property, it gets sent to escrow. Escrow basically pays out whomever is on title, and we always record our notes through escrow. So those are recorded deeds, and we get paid out first ahead of the owner's equity position. So those are just a handful of reasons why we absolutely love being the bank, but we're going to share some more tips and ideas. And as Terry mentioned, we're going to talk about two different strategies here. We're first going to talk a little bit about lending on fix and flips, and we focus our business on local fix and flips in California. And then we're also going to talk about the non-performing note side, and again comparing and contrasting the two different strategies when you're owning paper. So just kind of going down the list, lending on fix and flips here, you're creating the loan. So as the note creator, you have an opportunity to kind of vet out the borrower, kind of get to know their business practices. You're also counting on some steady monthly interest typically. You have a known exit strategy, and that known exit strategy is you have a performing note, and that note's going to pay off in the ideal and typical situation. You're able to do a better upfront inspection of the property. You could either send a reliable appraiser out there. You could send a broker out there to get a price opinion on that. A contractor, you yourself can walk into the property and inspect that before you choose to do the loan. Most of the loans that we do, in fact all the loans that we do as far as creating the note, are non-owner occupied notes. And there's a lot of lending laws surrounding owner versus non-owner occupied notes. So we always work with the non-owner occupied notes, and that allows us to do a faster foreclosure should something go wrong. Knock on wood, we never had a loan go bad, but should that happen, we are able to do a much faster foreclosure as lending on a non-owner occupied property. We're also able to take a look at what we call protective equity, and I'll go into that in a little bit more detail in just a moment. But protective equity is really securing your position. So when somebody goes to buy a property, they typically have some sort of down payment. That down payment is more risky than the note holder. So I'll talk a little bit more about that in detail. But we use protective equity to manage risk. And then typically a performing note is quite a bit less work than a non-performing note, and we call the terms. So we can say if it's a 6-month note, a 12-month note, the notes that we create are typically a short-term note of 12 months or less. And to contrast, on the non-performing note side, one of the biggest benefits about purchasing non-performing notes is you can get these notes at just a huge discount. Some of the notes that we bought, we've purchased for less than 10 cents on the dollar, and even including some of the notes that we hold in California. So you could get a substantial discount on those non-performing notes. When you buy a non-performing note, there is no initial payment stream. So unlike having a fix and flip loan, you're working to get towards that payment stream or some sort of payoff or exit strategies. And there's multiple exit strategies. We're going to talk about 5 of those here when we get to that section of this webinar. But there's lots of different exit strategies that can help you bring income from your non-performing notes. Unlike when you're choosing to lend on a property, you purchase a non-performing note. You can't enter the property until you have permission from the borrower, and typically you don't get that until later down the line, if ever. So you have to do exterior inspections when you're purchasing those non-performing notes, and oftentimes you can infer from the outside of the house what's going on the inside. That's not always the case. Sometimes we're happily surprised, sometimes not so much, but that's one thing that you do need to know. You can't enter the property when purchasing the non-performing note. There's also borrower protection laws that we have to follow guidelines on, and making sure we have the proper disclosures done at the right time by the right sort of entity that's licensed in that state. More often than not, the loans that we're purchasing are substantially underwater. So just to give you an example, we might purchase a note for $10,000 that the note balance is $100,000, but the property has declined in value and is maybe only worth $50,000. It's still a great deal for us because we have a lot of wiggle room to work with the borrower, but the initial loan is substantially underwater, and maybe the reason that's driving that borrower not to pay, because they say, well, why bother? You know, I'm $50,000 underwater, but we can help solve that problem through modifications. The process of working through a non-performing note, of course, is a little bit more involved, as I mentioned before. There's multiple exit strategies, and you know, you really kind of jump into that note and see how the borrower is going to react. But the opportunity is huge. So we're going to talk a little bit first about the asset-based lending when we're creating a note, and then we'll go into a deeper dive on the non-performing note side. So if we're looking at creating a fix and flip loan, we're going to give an example here. Let's just assume that we have a house in Orange County, and it's worth $500,000 in its after repair value. We have what's called a protected equity cushion. And so in this example, we're going to create a loan of $325,000, which is only 65% of the after repair value. And typically what we do is we lend somewhere between 65, 70, 75% of the after repair value on a property. This gives us what we refer to as protective equity. It gives us a cushion should that deal for some reason go bad. I like to call this the downside is the upside. If I made a loan for $325,000 and that house is worth $500,000, if I get that loan back, I have a lot of room to put this back out on the market, even at a discount, to fire sale it. I'm going to make more money owning that property and taking it back than I would if I just had held the note and got it through performing status and resale from the borrower. You know, we never want to see that situation happen, but should it happen, that protective equity is substantially managing our risk. And with that, Terry's going to talk a little bit more about ways to manage risk.
Yeah, so we do several things whenever we lend money to a rehabber, and this is where, again, as we were saying, when we lend money, we're creating a new note, so we're creating the paper. And the ways we manage the risk, first off, we always make sure we have a licensed appraiser or a broker do what's called a BPO, which is broker's priced opinion. So we have a third party go out and review the property and tell us what they feel it's going to sell for on the aftermarket. We always use licensed loan brokers to transact the deal. And along with that, we also use licensed escrow and title companies as well. And they just help protect your position. They help dot all the I's, cross out all the T's, and make sure everything's done in the appropriate manner. We look at the property ourselves as if we were going to do the rehab. Now, Aaliyah and I have both done rehab in the past, and so we will go through and analyze the deal and decide, is this something that we would actually do the deal on? And there have been many instances where we've said no, and so we push back and we'll tell that to the rehabber, and many times we're like their conscience, we're their best friend, because we can give them advice on what we would do or not do based on how the deal looks. We do construction draws, and what this means is, let's say we loan the rehabber money. Well, we don't want to give them all of the money up front because, you know, what if they got hit by a bus, God forbid, and then the money is just in their bank account, or let's say they took off to Mexico. So we want to put some safeguards in process here. So we will put the money in an escrow account, give them a portion of that money, have them do some of the rehab, and then when we've verified they've done part of it, then they can come back and take more. So those are called draws. So we give it out little by little as the project progresses. We only work with quality borrowers, and by quality we mean that we look at their track record. We really don't work with newbie borrowers, not that they don't have a place, but we like working with borrowers or rehabbers that have done deal after deal, and they've got a really good track record in tow. We have relationships with our first position lenders. Now, Aaliyah and I, we like to specialize in second position loans, and some people think that this is somewhat risky, but if you have a relationship with your first position lender, in order to stay control of that deal, you just need to understand if the payments are being made on that first. If they're not, you keep making payments, and that keeps us in control in the second position. And then we also keep a close watch on real estate market cycle and trends. Right now we're in a really nice upturn market, so we've got a lot of great deals and feel very confident. But as the market starts to shift and turn and you start to see a decline like we had several years ago, we become much more conservative. And that equity cushion that Aaliyah was just talking about, we keep a very, very close eye on how much of a spread we have in our deals. Now, the typical deal that we have, it is a rehab loan, as I mentioned, on fix and flip. We talked about this a little bit, that we loan at 70% of the fair market value of after repairs. We do it for 12 months. We'll do it either in first or second position. And for those that aren't aware of what first or position means, first position just means that, let's say you put a mortgage on the property, or in the state of California it's called a deed of trust. A deed of trust is basically the same thing. And if it's the first one on the property, that just means you get paid off first. If you're the second position, that means you get paid off after that first position gets paid off in the event of the sale. Now, we do our deals with 8% interest or more, so we get a nice interest rate, especially for being in second position on these. We always do them non-owner occupied. There are laws about lending to owner occupied deals, so we don't want to even go down that path, so we stay with the non-owner occupied, and we do 1 to 4 unit residential properties. And then we stick to properties within Southern California. It is our backyard. We're both in this area. We're networked in this area, so we like to stay in our backyard where we can easily see the progress of the rehab that's being done, and should we need to take over the property, we're very comfortable doing that. Now, some of the deals that we've done, this is just an example to give you an idea of what we've done on a previous deal. This property was in Los Angeles. It's your basic bread and butter home. It had an after repair value of $260,000. Purchase price was $176 and change, with what's really a rather small rehab amount of $8,900. There was a first position trust deed of $141,000, and then we came in and brought the money for the second position deed. So what we did is loan that rehabber $40,929. So if you add that up, the $40,000 plus the $141,000, both the first and the second position, and you divide that by the after repair value, that gives you the combined loan to value of 70%. So again, we're still maintaining an equity cushion of what that property is going to sell. So should something go wrong, we can take it over, and we know we've got some cushion there to easily sell it and make sure we preserve our interest in the deal. Now, what's nice about these deals is you can see we get paid a monthly interest rate of $341 on this every month coming in. And again, because we own the paper, we don't have any of the liability or the headache that the owner of the property has, yet we're making a nice monthly income. So that's why we love these deals. And you can see here, this is just a sample of some of the rehab deals. Now these are some of the more expensive, nice, higher-end properties. But you can see we work with borrowers that do some really, really great work.
Yeah, I especially like that last one there in the corner. That's the one that's on the market. The one in the lower right corner, it's on the market to sell. That one's selling for, I think, $2.2 million in Rancho Santa Fe. So very little dollars into the deal. They bought that for 1.4 on the loan and selling for 2.2, and that's actually a fire sale price. So there's a lot of profit to be made by the borrower in that deal. Lots of equity cushion. So I wanted to talk a little bit about the current market. Being in California, it's a little bit different than other parts of the U.S., but overall, there's a limited supply of deals, and that's just of a nature of the cycle. Supply, supply and demand, it shrinks and grows with each portion of the cycle. So several years ago, we saw lots of REOs and short sales. We saw people going to the auctions and picking up properties, and even a lot of activity through the MLS. But these days, especially in California, it's really hard to get some supply of deals. So notes is one of the places that a lot of the hedge funds and even individual investors are going towards so that they can get their hands on some substantially discounted deals, which is really great. And as we go to the next slide here, we're talking a little bit about REOs versus notes inventory. It's almost a 10-to-1 ratio, the volume of the notes. This was done about a year ago. This PowerPoint actually came from one of our mentors, Eddie Speed, who's an expert in the area of non-performing notes. But as you can see here, there's substantially more supply, almost 11 million non-performing notes to less than 2 million REOs in the last year. So the market opportunity for non-performing notes is pretty strong. This is why we decided to add this to our portfolio of projects that we're working on in addition to just doing the private lending. We wanted to jump into this because the time is honestly now to do this business. I've never seen anything quite like this opportunity, and we estimate that it's going to be really strong for another 3 to 5 years. There's a lot of underwater loans that are regaining equity, and so as the note holder, if you're buying those at a discount, sometimes you could just sit on those notes and wait for appreciation to occur. And we know that that's a strategy that a lot of people have when they're purchasing second position non-performing notes. They just kind of wait for the equity to rise so that they get some coverage and can have more leverage when they go to collaborate with the borrower. There's also something called loss share agreements that are expiring, which has increased sell-offs in the recent years. FHA actually prevents HUD from foreclosing on the notes. So they're doing a major sell-off, but that does not prevent the investors who are purchasing those non-performing notes from being able to foreclose. So the investor, the private investor, just like us, has more capability and different exit strategies than some of the restrictions that are placed on HUD. And really, there's billions of notes, and there's billions to be made from solving big problems. I mean, if you look at any major challenge in our society today, that is where the money is made, is when there's a big problem that is needed to be solved. And certainly working through these non-performing notes is a big challenge that we can help as investors solve for individual homeowners and our society. And it really creates a win-win scenario for both the investor and the underwater home borrower, because we're buying these notes so cheap. We're able to have that cushion of equity, kind of like we were describing with the performing notes, to be able to go back to the homeowner and collaborate with them in a way that's a win-win, and being able to work out and hopefully either keep them in their home or allow them to walk away from that property with some dignity and not a foreclosure on their record. So it's kind of the last strategy that we want to pull on a borrower. So this is just a few bullet points of just the tremendous amount of volume that's really out there. HUD has $400 billion in loans to sell over the next 5 to 6 years. Fannie and Freddie have also mandated that they need to sell off their distressed notes over the coming years. So really, again, some huge opportunity for people interested in this. And I would say the sooner you can get in and get educated on this topic, the better if this is of interest to you. So we'll talk really quickly about some exit strategies for notes. I'm going to actually transition this over to Terry to talk about the exit strategies since this is her area of expertise on the team.
Yeah, so we do a lot of different exit strategies, and that is one nice thing about the non-performing note business is there are a number of different options. In fact, there's even a couple more iterations than what you see here on the screen. But let me just kind of touch on a few of these here. We can sell the note. So we purchase the non-performing note, and then you wholesale it, just like you might wholesale a property. You can actually sell that note for just a little bit more money, and so you can still make a really nice profit, and all you've really done is buy the note and sell it to somebody else. You can also approach the homeowner to do a loan modification. So, for example, we know, Mr. and Mrs. Homeowner, you weren't able to pay your mortgage and what you were paying before, but what can you afford to pay? And perhaps because we're buying them at such a low discount, we can still make money. There's still room in the deal where we can give them a discounted monthly rate on what they're paying and modify that loan, but we're still making a nice income stream and making some passive investment coming into us from doing that loan modification. And again, we don't own the property, right? We're the bank. And so now we're receiving that passive income stream from them. We could also approve a short sale. So they've been in default. And most people, when they think of short sales, they think of long timelines. But in this case, we're the bank, right? So we approve it, and we already know we're going to approve the short sale. So we would get a real estate agent involved, and they would work directly with the homeowner in this case. And they would have the listing, and they would find a buyer for the property. And once they found the buyer, they come to us, we agree on the price, and we approve the short sale, and it can happen in a very quick period of time. And we've got a couple of examples coming up, and one of these is a short sale that I'll share with you. I'll show you some actual numbers. Now, if we can't get a hold of the homeowner, then sometimes we're forced to do a foreclosure. So if that's the case, then that's what we'll do, and then we get the property back. And now we own the property, and now we'll sell it on the retail market, or we'll sell it to a rehabber if it's in need of repair. If we can get a hold of them, and let's say a loan modification or a short sale or none of these other strategies is appropriate for them, then we can ask them to do a deed in lieu of foreclosure, where they turn over the deed to us instead of us putting a foreclosure on their record. So we always try to come up with a strategy that's a win-win for everyone. We really do want to help the borrower, and because we purchased this at such a low price, it gives us a lot of wiggle room and a lot of ways that we can make money and still help them at the same time. So let's look at a couple of examples of these. We were just talking about a deed in lieu, and this is a great example of one we did, where back in 2012 we purchased this note, we purchased the note for $7,500, but the value of the property at the time was $25,000. So this obviously isn't in California, this was in Wisconsin, but you can see that we're all in, when you consider taxes being paid, for $10,000. And we always want to include the taxes, because if taxes are owed, we don't want the property going to a tax sale and then we get wiped out. So we always consider wanting to pay taxes so that we can guard our position on it. What we did is we were able to get a hold of the borrower and do a deed in lieu of foreclosure. We then took over the property, we listed it, and we sold it for $24,000. So you can see that it was currently worth $25,000. We sold it for a little bit less at $24,000. We had some closing costs and fees. But since we were only all in for the $10,000, our profit was $10,381. So a really nice return on investment for this of $136,000. Another property here is an example of a short sale that we did, and this one was just last summer. We purchased it for $11,000. It had a small amount of unpaid taxes, so we're all in for $11,563. The estimate at the time, it was worth $25,000. Just happens to be the same amount of that first example. This one was in Missouri, so again, not in California. These are smaller, cheaper properties, bread and butter, kind of in the midsection of the country. We did a short sale on this, so we didn't actually take over the deed. We stayed the bank. We had an agent work with the homeowner to list the property. We found a buyer. We got a cash offer, and actually on this one, we had a number of buyers, and we were able to get a highest and best offer because we had several cash offers come through. We had some fees, and when all was said and done, we had a nice profit of $15,937. So if you, again, look at what we purchased it for, we were all in for that $11,000. We had that sale of $30,000. It was a really nice return on investment for us. Another property, this is just an example quickly of one that is reperforming. And so we were all in for $11,000, had a current value of $33,000. But what we did on this one was a loan modification. So we got them in with a monthly payment that they could afford of $336 a month. That gave us, as you can see, the yearly income there. And if you annualize that profit, it's $58,856. So this is an example where we didn't sell it and get all of our cash back, but if you annualize that income stream, and we get a nice, real passive cash flow coming to us from this deal. Now here's an example. This is kind of interesting. Take a look at that property, and what you'll notice is that this is a vacant land, and it's very vacant, as in the property was no longer there. We were all in for this one. We purchased it for $7,500, and what we subsequently found out was there was a city lien on the property for $102,000. Now, this was for bulldozing the property. So the city had come in, said it was unfit for anyone to live in. They bulldozed it down. Now, why they had a $100,000 bill for bulldozing, not sure. But regardless, that was on there. What we ended up doing, because the numbers just didn't work out for any other exit, we ended up donating this property to Habitat for Humanity. And they, because they are Habitat for Humanity and they have a little bit more leverage with the city, they were able to get that lien removed and forgiven from the city, and went in and then took over the land and finished out the project. They were going to build a nice home there, and it's good for the community, good for Habitat for Humanity, and ultimately it was good for us, because while this was a smaller profit than we've seen on other deals, we were able to get the tax write-off of this property. So here's where we were talking about multiple exit strategies. And even when you have one where at first glance the numbers don't look like they work out, we were still able to make a nice return on our investment for this property. So I'll turn it back over to Aaliyah for some tips on buying notes.
Yes, so we'll get through this as quick as possible to respect everyone's time, but there's a lot of different ways to buy notes, and some tips and strategies on when you're looking at note pools. So if you're just getting started, or if you've been in this business for a while, there's people that are out there, a lot of them are brokers, some are banks, that are selling non-performing notes, and they're either selling them as one-off or as a loan pool, which is multiple notes altogether. And so there's a few things that you're going to want to take a look at. Now, depending on how cheap you're buying this, depends also, too, on how much due diligence you might end up doing. There's also a time factor involved. When you're getting a fresh pool of notes, a lot of times you do have to act quickly. So one of the things that is important for us is to have systems in place that allow us to go through and analyze note pools very quickly. But the top thing that you want to do is just sort of confirm the value of that property. You know, initially you might go online and take a look at Zillow or Trulia, some of those tools, but if you can, especially if you're, you've got a bid in and you're serious and you might be asked or counterbid to go up in price, we like to have somebody drive by the property once that note sale has been approved, just to make sure, A, that the property is still there, just like the one that we saw in the last example. The property or the home wasn't sitting on that lot anymore. We want to make sure that that home is there and more or less intact. Something else that's important too is to kind of get a sense of the neighborhood. You don't want to be in a war zone. Granted, a lot of the notes that we're buying are on properties. They're in, potentially B neighborhoods, sometimes C blue-collar neighborhoods. They're not like the Ritz-Carlton, but certainly you don't want to be in a war zone either. So there's a lot of areas of the country that we would avoid, parts of South Chicago or maybe areas of Detroit. We always take a look at the crime map and make sure that it's not in a war zone. We review the collateral file as much as we can. Sometimes this isn't available to us, but whenever it is, we do look through the collateral file to see what notes the bank has made and or any other purchaser down the line from that note. We review the credit report whenever possible, and this is especially true for when we're purchasing junior liens, also known as the second position notes that we buy. We like to know kind of what the credit behavior is of that borrower. And a lot of times we're buying seconds that are underwater, many times with a performing first, where that individual might have a credit score of 700 plus, which is pretty good considering they have a non-performing note. That might be considered an A borrower in our case, so we would take seriously a look at purchasing that note versus somebody who's got a credit score in the low 500s. Where they might have a lot of delinquencies on their credit report. We try to call for taxes and find out if there are any other liens on the property that would affect the purchase price of that note. As you saw in Terry's examples, on a couple of those we did have to come up with money to pay the taxes just to make sure the taxes were current so that we didn't get wiped out in a tax sale. We also will collaborate with other note investors, so we might do a joint venture where, let's say we have $1 million and another organization might have $1 million, but the pool is selling for $2 million. Doing that sort of joint venture and being able to kind of co-bid on a pool of notes gives us a little extra leverage and hopefully a better price. We do try to avoid the broker daisy chains, and what that looks like is, let's say Bank of America is having a sale. Well, Bank of America goes to a loan sale advisor goes to broker one goes to broker two. Somewhere down the food chain, we get a hold of this pool of notes, and we might get it 2 or 3 times from different brokers. So we just try to avoid that altogether and go as, if not direct, then one away from direct to the actual seller of the notes. And that avoids complication with the sale. It also ensures that we're able to negotiate the best price. And lastly, something that's very important in the note industry when you're buying non-performing notes, it's a very, very small community of people. Once you get into it, if you're not already, pretty much everyone who's a player kind of knows each other. So if you get known to be the person who's backing out of deals in the 11th hour, you're not going to do business very long in this industry. So it's really important that you have your funding lined up and you commit and you do what you say you're going to do, because this is definitely a relationship-driven business. Now, where to find some of these note deals? There's a number of websites, like FCI Exchange is just one example where you'll be able to post or search for non-performing notes or even performing notes, and those go for a little bit of a higher price because there's a fee for people to post those notes there. But if you're just getting started and you want to buy 1 or 2 notes, it's also a great place to find some reliable note sales and execute a deal just to get yourself started. There's note hedge funds, so our company Inspired Capital Partners and our fund, we do occasionally do note sales. In fact, we've got probably a few dozen notes for sale right now if anyone's interested. But note hedge funds, they'll buy in larger pools, So let's say we might buy a pool of 100 notes, but then we'll sell those off as 2 or 3 notes at a time to smaller investors who want to get into the business. So that's kind of your way of getting started, is by reaching out to those hedge funds. There's a couple of good conferences that we like to attend. One is called Noteworthy. That's typically in October or November, and Paper Source, which is coming up, I believe, in April or May. Both of those are typically located in Las Vegas. I think Noteworthy has a second show, a smaller one, sort of midway through the year in Dallas. But those are great places to network with other serious note investors. Once again, you could partner with other experienced note investors to do a deal, and this is how a lot of our mentors have worked, where they'll get a deal under contract, and maybe you've got some money set aside, like we were sharing with Brian. This is a great way to use your IRA, is to team up and maybe be the money and then be able to watch that note get transacted all the way through. So we have a handful of colleagues that have lent our company money to help us get started with our note investing, and have over the years been able to benefit from us doing a lot of the work out and them just being able to passively let their money be put to work as these notes are purchased and get worked through. Servicing companies, so for example, FCI is a servicing company, and they often will be able to be a good connector to helping you find the note deals at a discount. Other places, LinkedIn groups for distressed assets is a place where I'll occasionally go online and connect with people. Banks, there's something called Lane Guide. And what Lane Guide is, it's a small annual fee that you pay to get access to all the banks and their contacts, and this is a huge, huge resource for anybody who's interested in getting the notes. So I would definitely check out Lane Guide and also Distressed Pro to get access to the banks and the assets that are for sale. And then lastly, I know I mentioned, stay away from broker daisy chains, but reputable note brokers can provide good value, and we've actually purchased from some of them as well. So just really quickly, what we've covered is ways to profit in today's real estate market with notes, specifically buying non-performing notes as well as lending to rehabbers who are doing fix and flip transactions. We've showed examples of how owning the paper can be extremely profitable, and ways to manage your risk on lending deals as well as buying the non-performing notes. We showed a few examples of how to exit a note deal, as well as the locations as far as where we invest. We typically find the best deals are in the Midwest and not so much in California. I wouldn't necessarily say that's true on the seconds. We buy a lot of California seconds because those are in hot demand and it's appreciating market. So really it's defining your strategy and then locating the notes that fit both your strategy and the lending and foreclosure laws in each of the states that you're interested in. And then lastly, where to find deals and tips on getting good deals with the notes. So I just wanted to, thank everybody out there for your time. We're right here at the hour mark. Terry and I are really grateful that you spent today with us, and thank you also, Brian, for setting up this webinar and giving us an opportunity to share a couple strategies out there that people can use their IRA funds. Our company's name is Inspired Capital Partners as far as our fund goes. We do have a separate company called Investors in Action that solely focuses on the fix and flips and education. But as representatives of Inspired Capital Partners, we do thank you for your time today. And if there are any questions, we're happy to address those online or offline.
All right. Well, thank you guys both. A lot of information there, and I apologize if I introduced you incorrectly at the beginning. You guys wear so many hats. So we do have a few questions here, which we'll try to get to. We're going to have to keep it to a minimum. We are at the hour mark. So for those of you, here's Terry and Aaliyah's information. We did record this webinar, so it will be available. So please email myself or Terry and Aaliyah later today, and we should be able to have that for you. A couple of questions here. Beautiful ladies, nice to hear from you again. Do you loan 70% on completed value for ground-up construction deals? Any interest on small loan-to-value for fix and flips in the Southeast?
I'll punt that to Terry.
That's not our specialty as far as lending goes. We do focus in Southern California just because it is our backyard and because some of the investors we work with are in this area too. We have looked at deals in other areas, and so we like to say that we are always open to deals, and if it's a good one, you know, we'll figure out either a way that we could do it, or we're pretty well connected in a lot of different areas. So if there's somebody else we know of that might lend in that area, you know, we could certainly pass them, pass the deal over to them, so we could maybe connect you. So I would say, as far as lending outside of Southern California, not really, but we'll take a look at it, like I said, and help if we can. As far as ground-up construction, that is something that we might get into, but right now we're really focused on something that already has a building in place. It's just less risky for us.
We actually have 2 of our recent deals are ground-up construction deals, but we came in, I would say, in the 10th hour, where there was solid framing in place, and so it wasn't really from the ground up breaking ground. But we do have colleagues and brokers that we work with on a frequent basis that are getting into the construction loans, and typically they'll loan about 50%, 60% of the project costs, and usually that's Terry talked a bit earlier about putting funds in escrow and being able to release construction draws. That's typically what they do. So just like she mentioned, we have a lot of resources and contacts throughout the U.S. that do this type of work. If we're not the right person or matches our criteria, we probably have a contact regardless. So definitely shoot us the deal and we can try to connect you.
All right. My next question looks like it's for me. Brian, can I do a direct rollover for my pension, and what are the fees? The answer to that question, like I kind of mentioned in my presentation, is you need to ask if you're still working for the company if your plan allows for an in-service rollover. If it's from an old pension for a company you no longer work for, yes, you definitely can roll that over to an IRA with us. The fees for an IRA with us are $275 flat annual fee and a one-time setup fee of $50. Another question from the same person there says, asked if we can email them a copy of the presentation via PDF. I can definitely do that. Aaliyah, Terry, will you guys have that available if somebody emails you?
Yeah, that's fine. I can do a PDF of.
Yeah, so just email us.
Absolutely.
You can see Terry and Aaliyah's emails there. My email is briandavis@acuplan.net. See, the next question I have here. If I fund my 1K, the solo 401K account, and it's not enough to purchase the property, can my friend lend me money? The answer to that is yes, if they do so on a non-recourse basis. Contact me further for more details on that. Thanks for the presentation. If I set up a self-directed IRA and fix and flip, what fees would be charged payment transaction? So Paul S., contact me directly. I can go through all the fees, but essentially our fees are $275 annual fees. If you start getting multiple fees, there could be some small fees after you do 12 in a year, but maybe a checkbook IRA is right for you. Here's a question you might have answered towards the end of your presentation there. Where can I locate non-performing notes? Is there specific sites where I can find deals on them? What's your opinion on the rumor that the next housing bubble is from shadow banking?
Shadow banking. Okay, so let me try to attack those one by one. I think we addressed where we can find the non-performing notes. If somebody's really interested and they'd like a more exhaustive list, they can contact myself. We have 2 people on our team, Brian and Philip, who are in charge of our acquisitions, so they might have some additional ideas as to where to find those non-performing notes or sites where you can buy one-offs, but we'd be happy to be a resource for that too. As far as the rumor about the shadow, I call this the shadow inventory, and I think that the question is, you know, really there's this bubble that's created, this phantom bubble. There's a lot of distressed properties right now. Distressed meaning that they're still underwater, there's still mortgages that are delinquent, and yes, there's certainly several million of those still left out there. And how these are getting worked through is, one, through price appreciation. So in California alone, tens of thousands of notes that were once underwater are now no longer underwater and have equity again. And so that's just part of the market cycle, and that's occurring across the U.S. Not in every single market, but in many of the markets across the U.S. I think we had double-digit appreciation in most of the major metro areas in just this past year alone. And that being said, there's still quite a few delinquent notes out there, and it does create some sort of shadow inventory, but a lot of those are being worked out by investors just like us going and buying the notes, going to the homeowner, and hopefully trying to come up with an amenable workout strategy that doesn't create a foreclosure, and perhaps that property never sees the MLS. So there are properties that are still trading kind of behind the scenes, a lot of times through hedge funds, that most people don't ever get to see on the MLS. So
Okay.
hopefully that answered that question.
If not, feel free to contact Aaliyah.
Feel free to contact me, yeah.
Last question I have here in the question section: will you loan on luxury homes $1 million plus?
We have done that in the past. As the market's starting to slow down, we're a bit hesitant to do so. We would take a look really strongly at the days on market in that particular neighborhood. We would take a look at sort of the demand for that overall area. Let's say, for example, you've got a house in Malibu right on the beach, and you picked it up for a screaming deal of $1 million, and the property is worth $5 million. Would we do a loan on that? We would definitely try to make that work, because we see the value in the upside. If it's one of those deals where it's on the fence of 70%, 75%, we would be a little bit more hesitant. So the answer is it really just depends. I'd have to take a look at the deal. We like to try to stay under $1 million just because of the turn time for the property and the demand of the pool of buyers that can afford to buy $1 million home on the flip side.
Right. Well, that's all the questions we have in the questions section. If anybody has any more, please feel free to contact us directly. I want to thank everybody for taking the time out of the middle of their day to listen to us on this webinar about being the bank and using your IRA. Aaliyah, Terry, thank you. A lot of information there. Again, we have this recorded, so if anybody does want a copy, please feel free to contact us, and we should be able to provide that for you sometime later today or tomorrow. Terry, Aaliyah, any last words?
No, just great questions, and thank you
for having us. Yeah.
Thank you, and we'll keep this up and do this regularly. We have a lot of interest in it, and I think this is an area that's booming. You mentioned paper source. I'll be there at the end of April. So, well, thanks everybody, and this is recorded, and just let me know if you want a recording of it, and everybody have a great day.